Welcome to this week's review of our stock market and any advice that I can think of. Nothing new, still selling. We're just looking at a few sectors. We're looking at the NASDAQ 100, the S&P 500, regional banks, long-term bonds, 25, 30 year and then 20-year long-term bonds, and then the uh, ETF for finance in general. And we see that those regional banks, which are typically nice and strong during a market problem, because of the bank failures and the uneasiness with them, they have crashed dramatically. They have lost 27% of their value in a very short time. It's enough that the entire financial sector now has been pulled down. Moody's has downgraded all of the regional banks to not acceptable negative rating, which is a terrible thing. That it's almost for sure you're going to have more bank failures. And if we had 10 bank failures, the government might cover 2 or 3 of them, but they're likely not to cover all 10. And if it gets even worse than that, they're just going to have to sit back and watch it all go because there's not enough money to cover all the problems that we have. The other thing that's happening is finally a reaction to put money in long-term bonds. So if that continues, it may give us an out, those that have to have some money invested. If you don't have to, sit in cash and wait for this to go away. Nothing new, nothing new, nothing new. We're still out of the market on a long-term basis. Short term, we're still out of the market. We'll look at a blow up. The red line is the indicator that says when we get out of the market, and the green line tells us when to get back in. So the red line will fire, and then we may be out of the market for some period of time until the green line drops below another line, and there you see our go back in the market. And then the red line popped up when we went out of the market. Well, that may come back down, but we'll still be out of the market until this green line can then come on down below this trigger point here. And that may take another week. So if we have nothing but good news, a week from now, we could be getting back in the market. I doubt we're going to have a week of good news, but we'll see. No change on the portfolios. We're still cash. Merlin has to have things invested. They don't have a good cash, so they have a good short-term bond and a good income to try to get a little bit during this period of time. Nothing new while we're on a go cash. No change here. No change. We're still cash 100%. All right, we're taking a look at our 200-day moving average. What percent of the stocks are above their 200-day? That is our main determination on long term what's going on in the market. We're going to start with the Russell 1000. That's down here. All right, it triggered sell right here. Now, the S&P 500 triggered sell a little later. And then the NASDAQ 100 triggered sell even later. But part of the reason we have this one triggers, then this one, is that historically, clear back to 2006, the best trigger point for the Russell 1000 is 68%. That means when less than 68% of the stocks are above their 200-day moving average, we better go cash. For the S&P, the trigger point's 62%. And for the NASDAQ 100, our trigger point's 58%. So they could be acting almost the same and we'd still get this Russell 1000 goes first and so forth and so on. But now we look and we say, well, maybe we're going to recover and come back up here. Now we go and see that we're not getting a recovery on the Russell 1000 at all, nor the 500. They still are headed down, down, down. So this really can't keep up. Either these are all going to have to turn and go up, or more likely, our NASDAQ will not go up too high and it'll be coming back down on the same slope. So you see steeper slopes on those two and starting to get out on this one, but I don't think we're going to have enough good news to actually go back in the market anytime soon. If we go back and look at 2007, 2008, 2009. All right, let's go and look at the NASDAQ 100. Right there was the peak. And then serious, serious drops. But we already had a sell signal on the Russell 1000 right here, okay? We had a sell on the S&P 500 a few days later and a sell on the NASDAQ 100. So all three of them had triggered sell in a fairly short period of time. But we had the situation where this came back above the trigger line because the trigger line at 58 is lower than the others. And it said, go ahead and go back in the market on the QQQ. Well, at that time, I looked at it and said, okay, that's headed up. It's gonna be okay. And that's headed up. It's going to be okay. And I had y'all jump in for a while. We were in for maybe a month or so. And then this came down and we said, okay, we're going cash again. So we probably just broke even. We sat here and wrote it up and then said, oh, we got to get out. So that was, we didn't make any money. We didn't lose any money by doing that little hop. But now you see when this came down here, we're way down on the other two. So there's no question. All of them are headed down. And we never had another good signal until we got out here, clear past 2009. So in 2008, there were only a handful of analysts accurately called that crash. And they all wrote books and told everybody how clever they were. But all of you that have been with me over the years, remember back in 2008, we sat there high and dry the whole year, did not lose a penny. We were out in cash. And then once this starts to recover, you see that the percentage of stocks, once they get above 9%, 9% or 10%, so they're almost all the same. Once you've come down here and then start back up, it's pretty safe to jump back in the market. Your safety net is only a few feet below your high wire, the tightrope you're walking on. When you're up here, you're 100 feet in the air, and your net's down here, and you go, well, it's a lot more risky jumping in the market up here than it is jumping in the market when you've been way down coming up. And so if this is a crash like 2008, and it seriously is starting out like it with bank failures, we are here. We are here. It's been nothing so far, nothing like it's going to be. Okay? So let's all have a little patience and see what we're going to be doing for the next couple of weeks. Now, to finish off, we have both our long-term and our short-term on the same page just to review. Still headed down on our long-term timer, even though there's a teeny bit of an uptick. And the volatility, when the red band crossed the red line, it said sell. We do not get a buy on this particular line until the green line comes back below the green line. And that may take a week. So if we have a week with no trouble, this could also say get back in the market. And if we have a week without trouble, this will probably rise above the trigger line also. So you could have both signals say go back in the market. And I'll take a good hard look at both the S&P 500 and the Russell 1000 to determine, are they slowing down? Does it look like they're going to turn around? In which case I'd say let's go ahead and go back in the market, but be ready to bail. Or if they have continued down and we just have this weirdness in the hotshot NASDAQ stocks, I probably would stay cash a little longer. I really don't, being through as many bear crashes as I've been through, I don't trust a market that doesn't have participation in across the market. If it's just narrowed to a very slight area, that just means somebody hadn't got the story yet. Okay. So stay cash. Thank you very much. Goodbye.